Okay, so I want to take a look at what's going on here. Yesterday's going to play a big role, and I don't have a video going over yesterday, but we'll just take a look at this really quickly. Essentially what happened was we had some bulls coming in the morning, picking things up, and then coming in again and doing a pretty good job running things up. But then you take a look here at tension, and their impact, they were having an impact, but it wasn't amazing. So then as it moves up towards the highs, the bears get a chance to position, which doesn't work. And then it comes back, samples the bulls, who just give up. They just give up. And bearishness comes in. And what I mean by bearishness is there's no further samples. And I have this rescaled here because it really just takes off. So something happened. You can see the energy inside of velocity just really took off into the close. So I have that rescaled just so you can see everything else going on. So that's where we end up into the close. The market just dives, taking out this bullish position here, and the market opens the next day. Well, essentially what happened was the market dove down, was able to get a zero test here. And so the bulls had this chance. Some event happened that drove the market down to test their resolve on the daily tension. And the next day, the market was able to push a little bit lower with continued pushes down. You could see there was a push up. Maybe you can't quite see that. Let me zoom in a little bit so you can get an idea of a little bit of the battle that went on in the morning. There was a little bit of a push up right here, and the bears sort of did something about it. You see in prices right there. Let's see, right? You can see it's this move down here. But they couldn't hold on to it. It took off and turned back positive, and right through here, in this, everything above here in terms of prices, bulls were able to defend this daily tension. There was some back and forth that went on this morning, which I thought was really interesting. And the bears tried, I'd have to say, but they were unable to really accomplish any great liquidity that let them take over. I mean, you see right off the open here, decay pushed up, and there's the trapped orders, and they sort of struggled right there. You see that? So they got their trapped orders, they finished up, they struggled, and looking at tension, they didn't really show up. So even though they had this daily test that they could have used to their advantage, they failed to really accomplish any effective liquidity. They didn't pump tension. It turned against them almost immediately before moving positive. So their interest here was pretty low. And then the daily tension showed up, and they didn't even push a new low. You can see it pushed up. Daily tension pushed over that right there. It pushed over, and they didn't even get it down to a new low. And then it moved up, back up to the origin. Here's where they were sitting. It pushed over, and at this moment, daily tension was back over zero. The bulls had defended daily tension, and now the goal would be to say, okay, well, if they're going to have defended, then we need to trap in some bears, find the bulls, and see what we can make happen. So moving forward from here, we'll just call this whole morning essentially the bulls defending, since they were able to defend this daily tension here, which was messy and difficult. If you tried to interact in that area, it was very tough. Things were sliding around really quickly, lots of movement. I prefer to sit back and wait until it's clear before trying to take advantage of anything going on in the markets. And so I think it became pretty clear right up in this area here that the bulls had essentially defended. The next step was to find some bears. So moving forward, you can see that our velocity did come up and find some samples here. And the first sample right there, as you can see, we dip down, and it comes up. So right there, that once the sample happened, there wasn't any volume following it. You could track it down and say that this was the volume right there, essentially, because the sample happened first, and then the volume occurred here, and there's a chunk of volume right there that we can look at. Now, I thought it was pretty messy and unorganized, but that's liquidity right there. The one that I'm tracking is this one, which pushes up And right after, again, it's a little messy, but this was the most recent one that I'm tracking. You can see I have it marked there on my chart. So I think the bears had a chance to come in right there, chance to sell. Essentially, it was 2 chances, and it moves back. And through this time here, you could see that they even had impact on this. So we're seeing the bears sort of showing up. I mean, overall, their impact on tension is pretty low. I mean, this was pretty good impact. Even this was pretty good. But this is like, it is moving. So we're seeing them there having an impact, but it's not great. They're not advancing tension towards their goals. Like, tension's not getting closer to zero. It's not getting closer to crossing back over. It's just sort of showing there's some activity. Not amazing. So I'm tracking this one here. The other, this sample here, the first one that I was showing, didn't really have an impact or anything going on. So this one is the one I'm tracking because that one they actually did have some impact on tension. Well, following that, decay pushed under and finally gave us a signal right here with the bulls, and the bulls showed up. They were able to hit that, and you can see that tension out of that bullish sample curled up. And so we're seeing the bulls show up, and they're showing up right on the back side of this position. So the bulls are right here, right in line with the bears. And you can see it pushed up, even came back, tested that failed bearish position. Well, now it failed, but essentially their bearish position, it was very slow and just slow. Came back, tested that. So the bulls are active. They've defended daily tension. They got a retest out of it, and now the market moves up, pushing through the highs. So you get an idea of where the players are positioned at here, which is right in the guts of this range here. And you get an idea of what they're dealing with structurally in terms of the bulls just defended daily tension. The 30-minute, on the other hand, has had a hard time really going anywhere. So I think the bulls are more ennobled here. They have controlled that tension. They're really just looking to trap in bears and see what they can make happen. The bears, on the other hand, have just lost an opportunity. They were able to get that daily tension under. They even tried a little bit to defend right there, but they lost control of it. I don't think that the bears are feeling particularly good at this moment. I think the bears are feeling like they're stuck on the backside of a position. They didn't do it. They didn't make it happen. They had the chance. They failed to make it happen. It didn't work out. So we're looking at this 30-minute tension. The thing that I'm asking, the question that I'm asking right now, isn't about further sampling. It's not about where can we get more positions? How can we trap in more bears? The thing I'm asking is, where is safety for the bears? Just how far up this drop are we going to have to go before all the bears who thought that this was the top and it's coming straight down, it's crashing all the way back down to the pandemic lows, how far up this move are we going to have to go before we find their safe haven? And the easiest way to do that, I think, is to find all the major places where things happen. And I think one of the big events, the huge events, was this bullish position that looked really good after a day of bulls just hitting it out of the park, doing a pretty good job, able to impact tension. I think this is a really pivotal moment right here. This is the spot where it all fell apart, almost for no reason. So we can mark that out. And you could see it was retested, and that makes total sense to me. It came back up to the backside of it. We did a similar thing here, came back to the backside of the bears. And this is going to be a moment, or a price level where I think everything just changed. And it wasn't structurally all that great. This looks to me like a flex. Somebody decided to flex. The structure wasn't really in their favor. They weren't approved to have elasticity. The bears didn't get that set up for them. It wasn't in place. So structurally, this didn't line up right. So it looks to me like somebody just went, look what we can do. And they flexed. And it brought the market down. It's a capacity the bears totally have. They can do that. And you can see it can get violent and scary. But it was still a flex. It was still out of structure. It just happened. So
toy store.
We're not going to the toy store. So I think this is the most likely place for this to return to.
Storage.
Back where the market just fell apart as somebody decided to flex, or maybe they saw something. I like to think of it as a flex because I think in the end, that's the way it's going to work out. You're going to look back at this and go, oh, somebody just did that because they could. Now, it doesn't mean just because somebody flexed doesn't mean the market's immediately going to recoil back up to that. That's not what that means. It tells you what happened. It tells you the mentality of traders as we move forward. I think if you're an institutional trader and you see this as a flex, that what's going to happen is you're going to say, well, they didn't really do it the right way. There's a good chance this is going to recoil. And so as they look at events moving forward, they're going to view them under that light. It doesn't mean that it's going to automatically move back up, but it does help you color the events correctly as we move forward here. So if the market doesn't recoil, if it doesn't get back up to this level, if it doesn't come back up and it moves down, you're going to have this idea that the market, this whole thing started off with a flex or an out of structure push down that just happened. And the market doesn't get back up to that high. If it pushed all the way back down and this started a move down further, then you understand the character of how this moved. It is important to know that this was absolutely an enormous flex. It was a good old-fashioned 100-point move. From here all the way down was a good 100 points. Whoever did it, whatever group of people did it, made it happen, event that happened in the background, it doesn't really matter. What matters to me is they got through 100 points directly. This was as fast as you could get a 100-point move. Okay, have one of them help you make it, okay? So that's important. I also think it's important to note that this did wipe out a lot of structure from the previous days. The flex was incredible. They closed up the gap. They took out all these positions. Anyone from the previous day in this area got hit. This did a lot of damage. It was just a flex. Somebody decided to go ahead and do it. They decided they wanted to make that happen. That's what happened. So we're just dealing with the aftermath. So when you see the bulls defend daily tension, you see the bears struggle to really hit the market. You see the bulls come in and hit. You see it bounce off that and moving up. You should be looking at that in the light of somebody flexing. This doesn't, you can look at it as the news. You can look at it as something happened in the world. You can look at it that way, but structurally, this was done wrong. This was not done correctly. It was not done in the normal structure that we see in the way that things typically work. This was done in the structure where it was just like, go ahead, slam it down with a really high potential just coming right back up. Now, why do I think that happened? Well, I think it happened because right up here, we got a new all-time highs. We took the entire pandemic move down and we went ahead and just erased it like it never happened. And I think this was a really big deal for a lot of people, Anyone who decided to try and short this on the way down, the only thing you're thinking is this pushes a new all-time high is you're remembering why you shorted it. And you're going, oh my gosh, I was wrong. That's all you remember is the reason you got into it. It all fell apart on you. It wasn't real. So pushing that new all-time high, I think triggered a lot of people to actually face the fact that they were wrong. And they're thinking about the reason it was coming down. They're thinking about how all the terrible things that they thought were going to play out in the market didn't. That's what you're looking at when your trade goes completely south on you. That's what so many people are thinking about. I think a lot of people broke when this pushed to a new all-time high. A lot of people. Everyone who thought that the pandemic was going to drop the S&P 500 all the way down to $10 a share. I think that's what people were sitting there going, oh my gosh, I was wrong. I got pulled into the fun. I drank the juice. And you're forced to face that at that high. That's what you're thinking. Why did it move back up? What caused this move? I don't think that actually matters right now. I think what matters is all these people are looking back in their memories as it pushes a new high. And they're going, oh my gosh, I was wrong. And it's causing some real problems psychologically in people's heads. They're asking these questions like, what's real? What's real? I thought if a pandemic hits a country and everybody loses their jobs, that meant the stock market should crash. What's real? What is a market? Oh my gosh, I lost all my money. And I think that's what people are faced with right now as this happens. And I think this was a really important moment in the markets to see a new all-time high come in after all these events that were so, I don't know, sure. It was such a sure thing. It was such an easy bet. It was such a easy thing to do. I think that's what people were thinking. They were just, that's what happened. And so I think a lot of people did what people do in a situation like this. When you're completely wrong and you're absolutely at the end of your rope, you reverse. That's what it was, a revenge. It looks like revenge trading to me. That's what you do. That's what you do. You go, oh my gosh, I thought I was right. Well, obviously it's clearly going this way. So everybody decided to reverse. And I think all that volume that we should have seen just got completely bucket filled by all the brokers. Everyone just consumed it and it never hit the market. And then the market just did this, just completely dumped against everyone who revenge traded. I think this was a revenge trade. I think that's what it was. That's what I think is going on right now. And I think the market's dealing with the fact that so many people are stuck in this emotional pendulum that swung down, it swung back up, it revenge traded, it topples down, and the market essentially said there's more money in taking out this massive revenge trade. It's a worldwide revenge trade. I think so many traders are caught in this. And if they didn't get blown out already, that they're sitting here trying to hedge their position, because at this point, it's not a revenge trade. You are just insane. You've lost all your money. You were completely wrong about a pandemic crashing a market. You were completely wrong about your revenge trade. You were completely wrong every single time. You're doing horribly and you're stuck and there's no way out. So you're just insane. And at some point, everyone stuck in this emotional cycle is going to break. And I think the next thing to see is silence. First, you're super sure about yourself, then you revenge trade, then you try and hedge, then you just close and you walk away. That's what people do. It's what they do over and over and over and over and over and over. And I think we're looking for that next. And the question is, what's going to make you do that? At what point do you go, oh my gosh? Well, I think these lows here, I mean, just look at the violence here. It accelerated. A pop that just dropped. An aggressive shot that takes out anyone who doubles down. These were emotionally violent moves. They beat the snot out of anyone. I bet most people dumped. This was how many legs down? 1 leg, 2 legs, 3 legs, 4 legs. There were some overnight moves, 5, 6 legs down. That would hurt. So I think that what's happened is a lot of people have dumped. That a lot of people evacuated the market. They were wrong, they were wrong, they were wrong. And now they're looking at just going, you know, I'm not going to do this anymore. And the nice thing about having a bunch of emotional traders just get pummeled like this is that once they're gone, the market can go back to normal. Once they leave, we can just get back to the business as usual. And so the question that I'm asking is, well, was this all-time high, this push up to new highs to just really show people what's going on, was that just a part of extracting capital out of the market? I think that when it comes down to it, this was crashing. I think the market essentially, it crashed. It just crashed up because so many people, just like the Tesla trade, it crashed. Crashing is when everybody is wrong together and it just gets directional and just blows everybody up. So I think essentially this market just crashed up. And then it flipped back down just because of the revenge trade. And now we're sitting in a situation where the market is trying to figure out what to do next. And we've seen that the bulls are willing to defend. We have this big psychological roller coaster going on with a lot of people. And so what's it going to do? How far up can this go before anyone who chased this down realizes they're wrong? And that's why I think this is the spot. Are we going to push a new all-time high? I don't think that we've got that kind of mojo going on here. I think the market essentially just decided that it wanted to take out this massive body of people because it could and because it's obvious. And I think now that that's sort of dealt with, that now we need to figure out what we were trying to do beforehand. And so this is a question I was actually thinking to myself before, a little bit earlier today. What were we doing before the pandemic? I don't even remember. Remember when it showed up, what was everybody thinking about even before? Because it looks to me like the market has returned to where we were before anybody had ever heard of it. We've dealt with people who have essentially tried to chase it. What were we doing before? It's like, I don't even remember, but that's sort of where we are. So if anybody was positioned before that, large positions, could that play a role right now? Because we're sort of back in that area. We've sort of dealt with it. It's in the past. It's over. So what's next? What was going on before? And I've been thinking about this, and I honestly don't really remember exactly what was going on right before it showed up. I just remember hearing about it. I remember some things that traders were doing. I don't quite remember exactly like what narratives were going on before it happened in terms of like this structure that I use for really anything. And I think that the market is looking at trying to maybe go back to those things, whatever was happening beforehand. So that's what I'm looking at right now. I think we're saying, what kind of safety do the bears think that they have because this moved down? People are equating this directional move with strength, I guess. But from what I can see is they didn't actually gain any headway. That move down did nothing, but maybe test the resolve of the bulls who showed up, they played, they hit, they've kept control of daily tension. So I don't think that there was any strength in it. I think it was just an aggressive, violent flex. The market flexed because it could. So coming up next, the thing structurally, if we're just going to step back and say, well, what do we need just in general in this situation? What's next? Oh, wait, hold on. There's a question. Alex says, so he says, earlier today, tension was not down, even though the ES was down. So when we were still bullish, when came back and it came back up, tension told us that bears were wrong. So tension told us that the bulls showed up and defended this. If you were bearish, you should have been bearish from back here, or at least at this pullback here when it came back up, retested this position. If anything past, I would say anything past this section here, you're not a bear, you're a seller. You were chasing. So I don't think that there were necessarily bears here. Maybe right here, there were some bears who tried to defend daily tension right there. But it's not like they had daily tension in any real way before that. It's not like they had gained control of structure and everything was on their side and then it came back and was pressuring them. It was more like they had this tiny little window that was horrible and cracked and way too small. And they took a small-ish swing at it. Daily tension was just testing the bulls. 30-minute was still up. They didn't have control. This wasn't a moment where the bears were like, victory. This was like, that's not what that was. That's not what that was. It was testing the bulls because look, the bulls had control of everything. And then it pushed down and stress tested that idea. And they showed up and were able to pick it up in the face of the bears and pop it up. At this point right here, it was pretty clear. At this point right here, it was pretty clear that the bulls had gotten tension back over, and then the market needed to deal with the next event, which was trapping in bears, see if the bulls could defend that or pick up liquidity and turn those bears upside down to pump the market. And right now, the market is trying to pump. It's trying to pump. The bulls want to pump 30-minute tension up. That's what they want. They need to find bears to come in to do that. If they can't continue to find anybody to pick this up, then the position's not going to keep going. We had some bearish positions, but if you notice, this right here took all the way till about there to find the volume. This was messy. It wasn't organized. It didn't line up really well. The best probably bearish liquidity was this one here. You could see it finally showed up. We had volume after the sample, and then it pushed on further. Again, another sample there with volume right here. And now we're getting some back and forth where this is just turning into noise. And if you remember, the thing that I was thinking is a lot of people are just going to throw their hands in the air and walk away. And I think that this noise showing up here is starting to show me that it's just a lot of back and forth. There's a lot of things going on here. It's getting noisy. The bears are trying to hit and keep this from rising as far as I can tell. And you can see there's not a lot of impact. There's a little bit of impact. They are impacting tension, but they're not like getting this closer to zero or getting this further away. It's like it's not really going anywhere. So this is just sort of looking like stalemate behavior here. Just try and keep it from moving. We want to tire out all these people so they walk away, get them done with that emotional trade, and then we can go back to what we were doing before. John says he's seeing the 3185, which seems the volume trigger yesterday. That was the second leg down yesterday, 85. So that's okay. So that's this. That's this here, right about here. So he's looking at that. I'm guessing right there was the second, what he's calling the second leg down. Miguel, just to be clear, the flex down came from an institution, but they weren't the ones who were revenge trading. Yes, correct. They weren't the ones who was revenge trading. I think if you step back and you have any buddies who are swing traders or who are trying to trade or whatever, that the idea is that you had so many people on the move down into the pandemic, knowing, not believing,
The tablets.
knowing that this was going to completely wreck the economy. People who shorted that pandemic down knew in their bones that this was going to completely destroy our economy. And it turned out that the stock market bounced and just went straight back up. And so I think the thing to look at is not why did we move back up? That's outside of the scope of why I think it was a revenge trade. It was the people getting hurt as it pushed a new high were remembering why they got in. And they were going, oh my gosh, the pandemic didn't work. Oh my gosh, the job losses didn't work. Oh my gosh, everything I thought was true about a market completely fell apart. And it's blowing their minds. And then they're going, well, I guess if I'm completely wrong, I should reverse. So then they reversed as the market pushed up. And that was the revenge trade. It's one of those moments where that your whole entire world just gets shattered. And then you decide that that money was yours and that clearly you know what's going to happen now because since you were wrong, go the other way. So then you reverse your position. And I think institutions just saw that. I think that's what happened. They just saw that, this massive flood of people. And I don't think it was not predictable. I think that's actually a pretty predictable human behavior to flip your position because you say, I mean, you basically operate like this. You say, you see something, this is the thing you see, whatever that is, and it's obvious. You see the obvious thing. So you take on some risk. And the obvious thing turned out to be a total lie. It turned out to a lie because your risk is hurting you, not because the obvious thing was true or false. It's because in conjunction with the obvious thing, your risk is losing you money. You were lied to. It was a fly trap. You got stuck. And so what you do is you do this funny little math where you say obvious things are wrong. And so then you take your obvious philosophy and you flip it. And you multiply it by like -1. And then you revenge trade, which is now that you thought the market was going to crash, so you decide to buy. And that is what a revenge trade is. It's when you flip this little thing upside down and you decide to do this really stupid thing, which is change the direction of your trade because you got hurt. And it's a lot like a temper tantrum. That's really, oh, well, you're not going to do what I think you're going to do. Well, you're going to do the obvious. I'm going to come in here and I'm going to take all your money because I know what you're going to do. Oh my gosh. So they flip their position thinking they're going to get up, they're going to have an edge on the market because they know the secret truth. And the market knows what you're doing. At this point, what's important isn't that you're doing this, it's that you're predictable. Emotions have this funny state. Emotions always believe they're unique. And the more you feel unique, the more you run with a herd. It's the way that herds function. If you are running in a herd, I believe every animal in a herd thinks they are unique. Emotionally, they feel unique and they feel like everybody's following them and they're so special. And that running away from the herd emotionally should feel like you're following a group. Right? Isn't that the truth? Isn't that what we say to kids? You're like, well, if everybody else jumped off a cliff, would you? Like your little herd follower. And it's like, well, actually following the herd is doing what the parents are asking because we're all just following a big herd. We do the things that we think are good for kids that everybody's doing. We all send them to school. We want them to get educated. We want them to do certain things. Like we have all these herd mentalities. But if kids go off and be unique, you say, well, if everybody jumps off a cliff, would you? It's like, wait, that's this. I want you to be not unique. Actually, I want you to follow the herd because that's safe. So telling kids if they're following a tiny little offshoot that they're following a herd is insane. That's what it feels like though. Because if you follow a few kids off of a cliff, you feel like you're following the group, but you actually left the group. You're actually being unique. You feel like you're following a group, but you're actually being quite unique, and it's uncomfortable. So in this situation, when you think that this lie is hurting you and you do this, you think you're being unique, but you just started being predictable because people following herds are predictable. That's how it works. The more unique you think you are, the less unique you are. And my favorite example of this is pretty straightforward. A unique person, a really unique person, is somebody who decided to conform and do good at it, like a pianist. Somebody who followed all the rules, they practiced every day, they conformed, they were disciplined, and they become amazing. And in the end, their conformity led to them being unique. This is important in trading because people who are highly disciplined and work really hard and they practice and they conform to analysis and they understand it well enough that they comply with what they think is true makes you unique because everyone else just follows the herd, follows their emotions. They just do whatever they feel like is right. And the problem is that you don't feel unique when you trade with institutions. You feel like you're following a herd and it can be a little uncomfortable. And it should be. It needs to be. You need to feel uncomfortable because that's one of the telltale signs that you're not following the herd of unique people. And so I think that this big old huge revenge trade was just one of those moments when the herd was so big, the market just put reality on hold for a minute and went ahead with some bearishness. And when they saw those people come in, it came back down, the liquidity was ignored, and they slammed it down because there was just a lot of wealth there to transfer into their trading accounts. This was something that's really hard to predict because I don't have access to all that outside of reality data. You would have to be a bunch of brokers communicating, or you could have predicted it by saying, well, I think this is what's happening. And this is a tough trade. This was one of the hardest things that you could have done would be to try and short this down. Because that meant that you understood the entire market was totally betrayed. You would have said, this move higher isn't making all the 401k accounts happy. It's literally betraying everyone who thinks they know what markets are. And that betrayal leads to a revenge trade, and that's the only way you could have picked up on this, in my opinion. There could have been some other tools, but I don't think anybody should be sitting here saying, I have some analysis structure that suggests that this is going to come down, because that means that your analysis essentially is tracking the revenge trade. And maybe you have tools for that. I don't know. This is a really difficult one to track. Anyway, so those are my thoughts on why I think this came down and what I think is going on now, and why I think that the market has slowed down. And my expectations are not for this to continue down. I don't anticipate this moving down lower unless the structure starts to lean in that direction and we see that happen. At this point, it looks to me like this whole entire idea, this big flex down, was just stress testing the bulls who came out on top and said, yes, we're here, we're going to defend this. And so I'm constantly looking up right now because I'm saying, well, anyone who chased this down, because you know a bunch of people did, and you know a bunch of people shorted this little dip here, and you know a bunch of people are trapped in, this was just a big nasty trap in the end. The question is, well, where's safety for you? And I think this pivot right here is really one of the safest places for you to be like, well, it's not going to go all the way here. But of course, this right here was the first expansion bar. That's where it first just started to go. So this is the most obvious target, in my opinion. This is the most obvious place to see any bearishness positions. That would have been, this is the best spot. So I think this is probably the best immediate target to get to, is that pivot right there where we retested that bullish position that fell apart because the market wanted to flex. I think that the mentality for flexing may have started here, but really it showed its face, I think, right here. This fell apart, and then the bears decided, let's go ahead and flex. I don't even know if I would call that bears. I would just say the institutions, because it was just happened to be down. They could have done just the same to the upside. So I think this was the spot right here. This is the spot. This is the safety spot. This is where it all began. That was the moment when it all just decided to go straight down, and that's the place to get back to. That's the moment. That's the moment where the institutions said, let's go ahead and take their money. Well, maybe they said that before, but when they said with money, they said, let's go ahead and just really pillage that. Right here was the moment where I think it became kind of clear what was happening. See that it dropped down and then just started to grind. I think it became clear, oh my gosh, they're not going to buy this. And then this is when they first acted, I think. And that's the place I expect to happen. That's the safety spot. So that's where my eyes are at. My eyes are pinned right there going, this is going to trap all these monkeys in who are chasing it. And I say monkeys because they sing and dance when they're told to. Right here, this big old sing and dance bar. The bears gave a really halfway defense there. I think that's where we're headed. So on our way up, we're trying to collect positions, and these were terrible. I mean, this was so unaligned. These ones are a little bit better through here. So we got ourselves a position here. We got another one here. These are a little bit better, but these guys right here are going to pay. They're going to pay out. They're going to pay out to help this move up. But I think that's the target. That's where if you're an institution who's not keeping up, I'm not wrong until that position gets turned upside down. So a move up to here, right to there, is when an institution will go, oh my gosh, I know what's going on. So that's where my eyes are right now. That's where I'm looking. That's where I think it's headed. As far as I can tell, these bears who have had little tiny, they're impacting. You can see it's moving down a little bit. It's out of their position, but it's not great. And you can see, oh, there's a little dip here while I was talking. We have some volume showing up about the same time. I like to see the signal, then the volume. But at this point, even though my eyes are there, I'm still thinking stalemate. Like, I think the market wants to see everybody sort of throw their hands in the air and be like, I don't want to do this anymore. This is so dumb. It's all just a lie. That's what we need to start hearing messages like that on Twitter. It's all just a lie. Everything's rigged. Those are my favorite messages because that tells you that they got blown out. They've given up hope on the idea that they're going to make their money back. And those are the best comments because they let you know the market's going to go back to normal after some craziness like this. So messages that are just, oh, it's all rigged, everything's a lie, it's conspiracies, blah, 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 blah. And they're just walking away from the market because it's obviously beyond them. It's hurt them, they're upset. And so that's what I'm looking for right now. That's where we're at. And I hope I've painted a picture of where I think traders are, why I think this happened, what's going on next, why they're looking where they're looking, what the market's anticipating. Heatwave, you say that with a laughing face, but that's the game. It's part of the game. It is. It pretty much is. So I'm waiting for that whole thing to play out. I want to see the hands off. I don't know what that's going to look like, to be honest. I'm not entirely certain, but that's what I want to see. Hands off. Everybody's done. And then we can start moving back to normal. At that point, I also would start saying to myself, okay, well, what would look great in a hands-off situation? And I'm not sure. I mean, it's a story that's going to come up and it's going to creep up on us, and we're going to see that story play out. And I'm going to try to keep up with it as best I can. So I'm not sure. I don't know what that's going to look like. We could have anything happen between now and the end of the day. I just think that this is the spot. This is the thing that matters to the upside. And I think that this whole move down was disingenuous, essentially. It was unnecessary. It was motivated just for the sake of there were so many people on the wrong side. So at this point, okay, moving forward from here, the next thing that we need to see, if the bulls are going to take this up higher, they're wanting to see this curl up. So we got to see some trapping in some bears, and then we have to see some bullish positions. And this looks a little bit better. You see that? We're getting decay. It's red. We're getting some trapped orders here. This might be a little bit better of a position. We have been unable to reestablish the inversion. So you can see we had it inverted earlier today. Scale that a little bit so you can see. And it was an okay inversion. It was pretty good. Right about when the bulls got tension back over, and then it cleared right here. And the market's been trying to reestablish or figure out what it wants to do next. So this was when essentially the inversion ended, and then the market's been sort of trying to fiddle around with figuring out what it wants to do, and it's been unable to reestablish an inversion. A lot of times when an inversion is going to reestablish itself, you see it'll have it like here. It pretty much immediately pops back over and then stays over. Where in this case, we've had a hard time. So the market's sort of cleared out its inversion, its ability to rise prices using destruction. And now the market's trying to reestablish, figure out what it wants to do. So I'd like to see that reassert itself if we're going to move up higher. So our bullish sample, here we go. It's just about done. And then what these bulls need to see is to see some cash injection here that's going to rise us up. Now, I think at this point, we don't have any really great positions in this low. Other than this right here, there's not great bullish samples through this area. I mean, the first bullish sample is right here. So this market could easily come down to here, try and pick up anyone lingering around here because I think a lot of people are looking for a V. And so I think at this point, we could easily come down, pick up some stops before the market decided to move a little bit higher. That's a potential. I just want to make this really clear. Stalemate is the thing I'm looking for right here in this narrative. I think that the upside is in the market's looking at, but I want to see stalemate. That means everybody threw their hands in the air and they're like, forget this. Forget this. What? Sorry, I don't know why I said what. It says you have to fix the mic. Okay, you guys are talking about something. Okay, Miguel said, how do I know that they were positioned on that second peak? And I think you're talking about this one. I'm going to go with that. So it's because this sample right here, we had velocity move under, move down, grabbed volume right there, the green volume. And then those guys did nothing. So it was a failure. And the market leaned back up, tested it. So from the backside, tested and started to move. And right there is where bearishness showed up. Bearishness. It's hard to read. Where the bulls failed and then it just went. There was no signals, there was no samples, it just went. Before that, there was a bearish sample right here, which completely failed. It moved immediately against it. Tension went the wrong way. So these bears failed miserably. And then something changed in this section here. that led the market to believe that bearishness could come in. The bulls failed, and this was the retest of the backside of that position after it was established that they had failed. And so that's why this is the pivot I'm looking at. I think this little spot here is the one to look at. That's why I'm picking that. It's because of that. The bulls gave up and bearishness just that was the beginning of the flex, in my opinion. And there's a bunch of different ways you can flex. I mean, at this point, you can pend a whole bunch of orders right down here. If I pended a whole bunch, the market will move towards those to fill it. I could pend a whole bunch down here, and then it'll continue to. That's one way to flex. You just stick a bunch of orders on the order book, and it'll dive to try and fill them, because that's what they do. Or you can, right here, you could go and you could pend, like on your bids, just fill the ask with a whole bunch of orders, and then the market's going to start moving away as you consume all the immediate bids, and it'll just topple it. That tends to look more like this than a dive. It's grindier, where you just populate it. Or you could go out on all the stocks and you could hit all the stocks. Just find any stocks that are declining and just start slamming their bid and ask. You don't have to, it doesn't even matter, just slam both of them just as fast as you can. And then those stocks will start to decline as volatility starts to rise. And so you want to pick stocks that will move the advanced decline the most. So if you have a bunch of stocks, here's the previous day's close, and the stock is currently priced maybe just like right above here, and you want it to go down, just slam it, and then the price will move down, and then all of a sudden the advanced decline will tick down one. So you just find a whole basket of stocks with this condition where they're right next to that previous day's close, and they can easily be pushed down. Just go grab like 300 stocks like that, put $10 million into it, start flickering it really hard, it'll bring that advanced decline down a couple points, and then the stock market will chase that, try and like go, oh my gosh, so you could do it that way. There's a whole bunch of ways that you can manipulate this down, and I think they sort of use a mixture of everything. That's just the easiest. I think the algorithm essentially just says what's cheapest. Just do the cheapest thing. None of it's cheap, but do the cheapest thing. And then there's just good old fashioned fill 1,000 lot order. Just fill it. That's short, and watch the market just go down as it churns it up. There's a bunch of different ways you can do it. It just depends on what's available at the time. So when I say institutions slam this down, they flex that muscle, that's what they were doing. At that moment, they saw what was happening and they started to use their tools. So it's not necessary that you get a volume spike at these turning points, because that's not always the way that you manipulate the index down. You can do it in a bunch of different ways. You could fill huge options orders way in the money, not out of the money. So you sell a bunch of puts way up here, something where the put premium is greater than the margin requirement, which on the futures is about $12,000. So if you can get a premium that's greater than $12,000, you can drop a $20,000 in premium, and it's on the put. You go long a bunch of those. That's going to put downside pressure because there's excess capital to deal with. So you want to put way over 100, 200 points. It's just an amazing amount in the premium. And so that's why you see options filling way up in the money for lots of money. You're like, why would you do that? Put all your capital. It's because it pressures the price of the underlying. You want to dump a whole bunch of money in there. There's a whole bunch of things you can do that don't necessarily show up in immediate volume in the index that show you how things can get pushed down. There's a ton of things you can do. So, yeah. I mean, I think that all that behavior started right here when it was clear this fell. So that's why I'm picking that pivot. That's why I think that's an important pivot. That's the one to watch, I think. Right now, it looks like the bears have picked up, or trying to pick up, just position after position after position. And they're building in, they're trying to make this like wall right here. And looking at tension, they hit a little bit here. This one, it's moving down. So this looks a little bit more like it's just like, don't rise yet. And I want to see a stalemate. So I'm okay with this. The next thing that the bulls need, though, is they need to blast through that wall if they're going to curl tension back up and reestablish their control. Tension up, keep that daily up, and then tomorrow it's resilient because a move, if prices closed right here, if this opened lower, daily tension would be resilient to pushing under, and there may be a zero test. That makes it resilient. That's what makes it strong, is the fact that it's hard to turn those numbers over. That's its strength. Not that it's positive or negative. And then this shows its strength right here in the fact the bulls were willing to come and inject capital. So these guys need to pop this up higher at some point. The bulls want to pump this up. They do. And that's going to come at the expense of trapping in some bears, turning them upside down and running the market against them. The bears, what they want is they're saying to themselves, can we position ourselves, which they've clearly been trying to do here, can we position ourselves in such a way that we could get 30-minute tension and potentially daily down to zero? So they want to see this coming down, and hopefully tomorrow maybe they could get a cross or a trend cap where you get both of them under zero at the same time. And that would be a trend cap. And a trend cap just means they lost all the probabilities at roughly the same time, the daily and the 30-minute, and that effectively caps off a trend's capacity to keep running probabilities. And they could be looking at trying to get a trend cap right now. If we could turn that, if the bears could turn the bullish position that happened right about there, if they could turn that upside down, they might be able to get tension to pump down a little bit. At the way that 30-minute tension's moving, the best I think they could do is maybe get another zero test into the close, which I think would just inspire a lot of people to pop this up. I think if the bears are really going to do damage, they're going to have to wait until tomorrow. I think at this point, an aggressive move back down to the lows into the close today would just give the bulls another chance to buy into the lows. And they would. I think they would. So I don't think that a shove down is really all that sensible by the bears, just to push it into the hands of the bears. They can do it. We're seeing pushes down. We're seeing these positions holding together. We are. But if they push this down and they think, hey, we're going to shove this down and it's going to work, I think they're going to end up just giving the bulls another chance to buy into the lows. That's what this is going to look like. So maybe they come down and they want to retest these little levels here. So probably that one. This doesn't look like an expansion bar. That was, but it already got tested. So this is the one, the expansion bar they may want to test. That's what they're going to be doing. I have a really hard time thinking that the bears want to inject capital here in this moment to shove this all the way down to the lows just so the bulls can buy it back up and fold them over. It's not even elastic. The bulls, they still need to, this position here, the bulls didn't hit. So we could be looking at a nod here, and this is leaning down. We're getting some trapped orders right here. I'll be watching this. If this doesn't get hit right here, and this move down here under, and then we get these trapped orders which are showing up, and these guys don't hit, so we don't see tension curl up a little bit. We don't see prices move up out of it into like this area here. Then this could be looking like a nod, which could look like elasticity. Let me tell you the problem with that. Let me just tell you what the problem is. 16%. So the whole point of elasticity is that you have high level of tension and you can ride the wave. This is not high levels of tension. It's not. So in my head, I'm sitting here thinking, well, okay, so let's say that this moved down into the close or something like that. That's lame. It's lame. It's not high enough. You want a high level of tension to ride that wave down. So if the bears are like, ooh, let's get some elasticity here. It's like, well, like really? Why don't you let this get pumped up higher, get it up to maybe like negative 50%, and then pick up elasticity so you can actually catch 50 or 100 points out of this counter trend move. This is looking like, I don't know, forgot aggressive. Maybe they get 20 points, which is good, but not in this market. So I just think that that's ridiculous. Why would you want 16% elasticity? That's one of those situations where you work really, really, really hard to get what you want. And by the time you get it, they hand you an empty cup. It's like, here's your cup of, it's empty. And you're like, And this is actually a trap that we've tracked a couple of times where that you make the counterparty work, and then they finally get what they want, and it's dead on arrival. DOA. And then the market gives those guys a chance, and then it folds them over, and it was just a trap, a conceptual trap. And we've seen that before. And that's what it's just like, come on, 16? Really? You guys want an elastic market that's 16? Okay, so we're almost done with our volume here. And this is what the market's looking at. Those bears want this elasticity. They clearly positioned through these highs here. We can see they had some samples. These are the two that I'm looking at because the volume's nice and clear there. And there, they seem to have hit out of both of them. And it looks like we have tension moving out of both of those. So these are the two to really look at. And I think they're looking at trying to get in before the bulls give up, but they're putting themselves in a really precarious situation because if the bulls hit right now out of this position right here and it starts moving up, these guys are screwed. They didn't get approval. It's not structurally in their favor. If anything, I would say that these two guys right here are thinking this is going to happen again. They're like in memory of yesterday or something like that. Because they're in too early. The bulls hit right here and they're doing fine so far. And now we're getting this sort of double hit. They got it down a little bit, it kept going. And if this gets hit right here, these bears are going to be stuck in a pickle. So this is getting interesting. I think the stalemate still needs to be something I'd like to see. I still want to make sure that everybody throws their hands in the air and they're all frustrated emotionally and they walk away. That's number one for me. I need to see that. Because I think this is a big emotional roller coaster. We need to see conclude with everybody just going, fine, I give up. Okay, so the bulls are popping that out. You see that? The bulls are hitting. So it's like, bears, what are you doing? You trying to hit this down? You trying to hit this down? You think you're going to drive this all the way down? And that's somehow going to be successful. Well, the bulls are hitting here. Let's take a look at tension. We want to see tension start to rise. And you're going to say to yourself at this moment, okay, so these bulls right here, potentially, both of these groups here, they're roughly similar prices as the ones that hit a little earlier. They're looking to take out this position and this position, and they're looking to do that to the tune of up to here. This is the range they want to take advantage of. They want to get that back up to that root spot. Oh yeah, it does. Alex said, does this make it harder for bears tomorrow? Yeah, what the bears are trying to do today is position themselves so that they have an advantage tomorrow. Because the bears want to see if they can get themselves in a position to get this all down to zero, get daily tension down under zero, like that's what they want to do. If they're in a spot where they allow themselves, which is this here, they allow themselves to get turned upside down, it's going to pump tension into the close, and it's going to move everything away from their objective. It's going to get it further from zero, which I don't think is all that unreasonable. I mean, if the bears want elasticity, they're going to need more tension. I think letting tension build for a little while before maybe getting elasticity here and then riding a larger wave down is way better. Way better. There's just, I think, a lot of precedents to move up to that level. So I think this could shoot these bears in the foot and it make it a little more difficult. Maybe they should have just stepped back and wait, but they decided to hit. They decided to try and defend tension there. They decided to do all this stuff, and now they're kind of getting pressured. I mean, if I were a bear and I'd shorted this, I would be sweating bullets right now. I would be going nuts. Like, oh no, they're hitting. Man, this is just coming right back against me. You'd really have to think this was pushing another leg down to hold on to these positions. Sure, they're pretty good positions, but selling in here was a pretty good position for a minute before it wasn't. And so I think selling right through here looks okay for a minute, but they're running into the immediate problem. The bulls have defended daily tension. The bulls have some precedent to push this up to here. The bulls are doing great. They're screwed. They're just not doing this right. The bears are the worst. So that's where we're at right here. So this is going to move back up. We're going to get a sample here off decay. We're going to get another one here off of this. I think the best thing the bears could do is to step back and go, whoa, sorry, whoops, we messed that up. Because really all they did was push the market down into a bullish sample. And here's the original one. Here's the test of that. We're getting another test of it right there, and it's on the back side of this bear. I think probably the best bearish sample, which was a little unstructured, but that was the backside of the best bearish sample the bears have had, that they had since this whole thing happened. Though it was terrible because they had lost daily tension already. So now we're going to watch. Now, what I think the bulls could do here, it looks like they're going to have the opportunity to turn these bears upside down. We could push this up higher. We need to see tension. Look, there's tension. You can see tensions moving up. They've hit. The bulls are here. They've just filled a position there, and we're seeing the impact of that position. Let's see what these bears do. If the bears decide they want to do something again, because they're about to get this pushed right back up to zero, get another sample. So let's see what happens. I honestly think that these two positions are sweating bullets, and if they don't let go now, this is just going to churn against them. It's just going to go until they do let go, and I think this is the goal. This is the goal right here. That's the goal. Could we go further? Absolutely. When it comes to drawing out targets and stuff, my targets are always rooted in the structure of what's happened, because I think that there are legitimate positions right now still sitting here. Not that they happened here. I think they're still sitting there, and that those are things that matter to the traders. It's not because it was a pivot or that whatever. It's because I think that there are legitimate positions still sitting there with open orders, and their best option will be to unwind, and unwinding your position always zips the prices against you and stuff. And we can see that happen in real time, and that's why I track it, because I think it's useful that way. All right, so these guys, they're losing it. They're losing it. They're losing it. 73, so we just got to get this up through, 77, 78, and they're screwed. We get up 77, 78 in the last half hour. They're going to be stuck upside down, backs against the wall, realizing what they've done. They lost everything, and the market's going to want to return back up to where it was at when the whole shenanigans started, which I think started here. I think conceptually it started through this area, but they actually started about here. So that's what I think is happening here. We're looking at moving this back up to there. $74. So I'm thinking about what, 31.78-ish. At that moment, these guys are going to go, crap. It's going to get a little bit through their position. It takes a little bit before people really realize. Miguel, so they sort of. This is what happens if you try and fill up an institutional position without liquidity. It's clear to everybody what happened. You use liquidity so that you don't accidentally zip price away from your position and make it really obvious. But if you want to flex the market, you should execute orders without liquidity, because then things just get shoved. But it's expensive. It's expensive. So the point is that you can always push things around, but you don't make any money because everybody sees what you're doing. So they were able to shove that down, however they did it, whatever mechanism. I think just because I think there was likely some background positioning. In fact, I would imagine that there were dark pool positions right up in this area. And I'm sure that those will be reporting right now, because of course, dark pools only report after everything's over. So there was likely some dark pool positioning up in this area here. They did what they had to do to shove that down, and the whole concept would have just strictly been the fact that we knew it was happening. I can't track that. I mean, unless you see that coming in real, this is where I track it. And the whole point is you might be saying, well, how did you predict this? Say, I didn't predict it. I didn't know that was going to happen, but I know what happened. And so I know what's going to happen. And so it gives me further opportunities, just being able to understand what was going on. So what would it take to have So I'm gonna read that as what would it take to have bears in control? I don't think the bears were ever in control. I want to make that clear. This question was, what would be an indication to you that bears are back in control? And they never had control, so they wouldn't be back in control. This was not bearish. So this is not bearish. This was a flex. This is not bearish. They never gained control of probabilities. They never did. But what would it take to show me that bears gained control if we move back up to that area? I can answer that question. So what it would take is a lot. So what the bears need is this. We would have to move up to that area. Let's say we get there in price, and then things would have to move down. And in doing so, daily tension would have to be like moving under zero, which would never happen. There is a lot of work for the bears to do if they want to gain control. Tomorrow, okay, you keep saying back in control. They never had control. We never saw bears actually gain control of the market. That didn't ever happen. Let me show you why I think that's true. Here's the last time the bears got a sample. It moved up, they failed. The next time after that, the bears got a sample was here. It moved up, they failed to impact tension. They got a test on daily tension right there. They failed. It moved up. They got a sample here. They failed. Well, actually, this one they sort of were successful in that they were able to move tension down. And then they never had control of the market through this section. I don't think it's back in control. I think they never gained control. They never picked up successful liquidity. They never hit that liquidity. They didn't successfully gain control of tension. It never happened. It never happened, not once. So this moved down for another reason. That's why I'm calling it a flex. They never gained control. So this was just somebody flexing their muscles. And I think it has to do with the fact that this pushed a new high from the pandemic and people are flipping out. And they're trying to revenge trade the crap out of it because they just lost more money than they've ever made in their whole lives. And they're looking at a big old fat negative account balance. And they're like, oh my gosh, I've been trading for 5 years. And this just took all the money I've ever made in all of my 5 years. It was just turned into a huge waste of time. And I think people are trying to revenge trade the crap out of it. And I think that's why this moved down. People got hurt bad. That's it. They never had control. It was just about pummeling the punks in the market. And that's it. So in order for me to think that they had control, the first thing they would need to do is establish elasticity. That's the first thing. So they would need to see a bullish sample fail, which they just didn't get. So maybe tomorrow they'll get that. They would need to see some sort of sample fail. Then they would need some bearish liquidity. So first they would need to see the controlling party fail. Then they would need liquidity. And then that liquidity would need to pump tension. So tension would need to move down. Then once tension got to zero, they would then move from elasticity to sampling the bulls. So it would be like another stress test. And the bulls would have to fail. And then that would push everything under zero. And then the bears would need to pump tension, which means that failure turns into liquidity. So they would need to pump tension. So they would need further liquidity to pop in. And then at that moment, then the bears, as soon as they show that they can hit liquidity while being in control of tension, so these would both be green, then I would say bears are in control of the market. So this whole series of events would need to happen. This is one day. This is one day. So I don't know, a day and a half before bears could possibly be in control of the market. Is it possible? Yes. Is it likely? Heck no. Absolutely not. Bulls right now are in the driver's seat. Bulls right now have just hit liquidity. Bears are about to get the noose. Bulls are in control of this market. This is still a bullish market. We never for a moment had a bearish market through this whole move down. Everyone who shorted this down, if you made money, you are very lucky. That's it. You just happen to be on the right side of a market, where I'm sitting, a market manipulation. It was highly manipulative to drive this down, and I think I know why. At this point, I don't think it's bearish. I don't. I think that was, and I've tried to point this, I think that was pretty clear right about here. When daily tension popped back up, at that moment, it was like, okay, well, we know what just happened. The bulls defended. It's over. So that's where I think that came clear. Now we're just working out the structural details. Who gets to take what? Who's going to pay for what? Where are the bulls? Where are the bears? Where are we going to head to? All these little like details the market needs to work out. But that's what we need to go through. So you rewind back on the video. We need to work through elasticity, then the zero tests, the tension zero tests, and then the bears would need to pick up liquidity and pump the market in their favor. Now, in bears' defense, bears do like to just all yell go. That does happen. But we didn't see that yesterday. This wasn't like a successful bearish sample that happened to work. There were no bearish. There's no bearish liquidity. So I'm having a hard time sitting here thinking about bears pushing this down lower. Could they? Yeah, of course they could. Yeah. Is it likely? If anything, it's just moving down to give bulls another chance to pick up more positions. If I saw this push down into this area, maybe retest this expansion bar right here, I'd be sitting here thinking to myself, this is just trying to give bulls another chance to hit. That's it. That's all. So any move down at this point, I'd be looking at as just a favor to the bulls, because I think the bears need to step out of the way and knock it off. Let this rise, get tension a little bit higher, something maybe around, at least 40 or something. Just 17. Come on, there's no room to run. So let this rise before getting the elastic market, and then try and move. I just don't think it's sensible for bears to hit here. I don't. And so I think there's going to be some sort of correlation between this getting back up to this essential spot, pumping tension a little bit higher, and then at that moment we could take a look at getting the bears some elasticity and maybe get their foot in the door if they hit elasticity really well. If they do a great job with elasticity, then maybe they could look at potentially gaining control of the market. But at this point, everything that's happening, I think, is just in favor of the bulls. This whole move down, I think it was pretty destructive in terms of, taking out some bullish stuff, but structurally it wasn't bearish. It was just a knee-jerk response, a flex, whatever you want to call it. These are tough to deal with, because when you try and piece this kind of thing into your structure and your narrative, if you don't have a place for these types of things and you don't understand what's going on in the broad sense of the market, these things are just anomalous moves. They happen. And you can deal with that. You can just say markets can do whatever markets want to do. You can use that as a piece of your analysis to keep your psychology from just shattering when they happen. But I think in the context of what we just saw in a major move, that this was a pretty sensible drop back down. I think it had to do with just people. I don't think it was anomalous. I think it was very difficult, if not impossible, to really trade predictably. But I think it makes sense in terms of what was going on. I think everybody, that's all you hear anymore, is how the market's crashing while we're pushing new highs every day. Oh, the U.S. economy is falling apart. It's just falling apart. And that's all you ever hear. And then I bring up my stocks and I'm sitting here going, like, which one is crashing exactly? Which one of those? Which one? And I know overvaluation and it's actually moving down, but in the end, all the sellers who are right about overvaluation are losing their shirts. So what's more important to you, being right or making money? I don't know. So yeah, I think this is a huge question about what you think about the pandemic. That's it. That's true. Joe would lick a face ripper right here. Like a face ripper. Just destroy the bears. And I agree. I think that makes sense. I completely agree. I think ripping this market up, Joe just said, I totally agree. I think moving up higher is the game. And we could totally, I don't think it's going to happen. I mean, 20 minutes, I mean, it could happen in 20 minutes, but moving from here up to, the spot where I want to see it get to, it could happen, but I think it's more reasonable that we stalemate the market, move nice and slow, make this a real pain in the butt for everybody, and then maybe overnight we pop it up. Because, I mean, think about the amount of fear that a lot of you are probably experiencing if you're in a position. You're going, oh my gosh, this was a very aggressive move. Are we looking at the beginning of the second pandemic? No, we're not. But that's got to be a legitimate fear. We saw the market just totally obliterate everyone. So at this moment, after a move like that, you're going to be thinking, oh, is this happening again? No, it's not. It's not happening. So holding this off from really popping up into the close, maybe we close here. And then as soon as the market finishes the ACH, the bank transfers from broker to market and all that stuff that happens right after markets close. And then it just goes and pops up and then moves up. You go, oh, okay. Holding all those retailers out is a great way. Okay, so Alex, I don't measure volume the way that everyone else is measuring volume. Everyone else wants to measure volume by how many contracts trade. But in all my thinking about markets, that's not a reliable way to determine what's happening. You can make the determination that you can say this. You can say that greater volume, okay, greater volume over time. You need more than a single bar, like 10 minutes, 5 minutes. You can say that this is a thing. Greater volume over time is a thing. But a single volume bar with, 10 million shares on the SPY is very dubious. Go back and check. Go look at all the times that you see a large volume spike with one bar that's 10 million, or a single execution that's 1 million shares. And you'll find out that it tells you nothing, that there is no conclusive information from that. Does it mean up or down? Does it mean the market's going to move? It means nothing, because you don't even know if that 10 million shares executed at that moment. You don't know. It could have happened yesterday. It could have happened 10 minutes ago. It could be just somebody trading to themselves. It could be an institution rebalancing a position across the whole index, where that you're seeing 10 million on the SPY, but they're hedging that against shares or futures or options. And it's very messy to look at volume. It just doesn't tell you much. So what I'm looking at is patterns or shapes. There's an N in there. And this volume is not volume on the SPY. It's volume in the stocks. And my assumption here is that you're trading the SPY, and your position is a basket of trapped people in the stocks, and that you're hedging with the index with the intent to make profits in the futures, because futures have the best day trading taxes. So you want to make money in futures. You want to use the index to trade against stocks to create leverage and market pressures. And that's what we're looking at here, is a pattern of trapping in traders on the stock market to hedge against them. They're basically being served up to the slaughter. You think you're trading the apple, but you're not. You're filling a basket order to be bundled up and sold to the index, so that someone can trade a future against your entire position, and your account balance just got extracted into the futures market. It's gone before you even lose it. You just think you're trading the stocks because you're naive. And that's what's happening. That's what I think is happening. And that's what I'm trying to track here. And that's how I track liquidity. I assume that they're generating signals to stimulate trading on the stocks. They don't really care what you're trading. If you execute an order at the right time when it's needed, that's picked up, bundled, and sold to the index traders, the institutions. That's how it works. And so I'm not actually tracking the volume like most people track volume. I'm tracking a concept that works pretty well, really well, in my opinion. That lets us say, oh, these institutions just tricked a bunch of people in the stocks. Which stocks? Who cares? I don't actually care. There are 3,060 stocks on the New York Stock Exchange, and all we need is someone to fill enough volume on any of those in the wrong direction at the right time. That's it. I don't care who you are. I don't care what you're trading. I don't care that your stock's EP value was this way or that their dividends didn't pay as good, so it's going to crash. Or I don't care. You just need to fill at the right time when I need you. And then your position lost all of its value before you stopped out. It gets extracted up the chain, it gets passed around and sold, and that's what selling liquidity really means at the end of the day. It's not all the liquidity. It's just the liquidity when it's needed, when there's signals and samples and institutions are playing. That's it. The rest of the time, if you make money or you don't, I don't care if you make money on Apple. But if you trade when I need the liquidity, you're not going to make money on Apple. Apple is the servant of the index, always. And if Apple's too strong, well, we just don't use the volume from Apple. Let it do its thing. We'll go grab something from IBM, or we'll go grab it from Facebook, or we'll go off to some obscure XYZ stock. Doesn't matter. We just need the volume. And that's, at the end of the day, that's how it works. So that's what I'm tracking. If you're asking about the volume, I'm not looking for, there were some deviation of volume here, there. That's not what I'm looking at. It's the stocks getting bundled up here. That's what that green mark is. And then I use the new highs and new lows, which is the cumulative new extremes indicator here. And I sort of just tentatively glance at this through the day. You can see this is the amount of yearly new highs today, 9-month new highs today, 6-month all the way down, and this is them added up for the current bar. So you can sort of get an idea of that. So you could track these, and then you can see this is the prettier accumulation of it. So you can see there was new highs here, new lows, and they kind of go back and forth. More than anything, the thing that I think ends up happening with new highs and new lows, which is sort of the way you bundle up stocks, you see how sometimes they just disappear? So you have these days where there's just nothing, and then sometimes there's just huge amounts, and they tell you about activity in the markets. If a market can't move and create new highs and new lows in the stocks, it's going to struggle to keep moving. You need new highs and new lows to generate liquidity. It's just part of the game. It's not something I point out a whole lot, but it's part of the game. So if you can generate a new high, you can generate another. It's new highs bring in new highs, new lows bring in new lows. And so when you have them sort of like narrow out and you're not seeing a lot, that can tell you about the activity level in the market. Lots of activity, less activity. And then you start getting consecutive activity where you see these runs of new highs or something like that. And it's a setting that you can actually track in the indicator. And it's something I look at. A run of new highs tends to correlate with a run here. And that's a good thing. You want to see new highs showing up because that shows that these sellers are getting stopped out. That's what you want to see. That's what so we're just sort of looking at those stocks to see how the stock market's doing and how it's in conjunction with the index, picking up orders, bundling people up into products, a little bundle of volume. Here you go. Here's your orders. You can trade against those institutions. The institutions consume them, and that keeps their open interest from spiking, the OI, open interest. Because if you're an institution and you spike open interest, which I think there was selling open interest right here, this is what happens. And if you want a good price, you can't do that because price runs away. So if you bundle up a bunch of things, you can get all your open interest right in a nice little box here, and then it pops out of it when you're all done. And that's how it works. So that's what we're tracking here. When you see those change colors and stuff like that, the math is a little complicated, but the concepts I think are pretty simple. And that's what you should focus on, is the concept. We're trapping in folks on the stock market, which I think is totally sensible, and using them mask the open interest and to fill orders and stuff. And you can see how after you can, if an institution doesn't want the open interest, I mean, that's a thing. If I created a big chunk of volume and I hand it to an institution, and the institution's like, nah, I don't want it, and the market goes the other way. And we can track that. We could say, well, they didn't fill against that product. That means they're not intending to fill. They're not interested. And that helps you say they're not here, or they're willing to let the other side win, or something like that. And so we're just using all these little data points that we get along the way. And then we put them all together and we build the narrative out of it. And it's pretty straightforward, I think, at the end. Oh, we have 1 minute till our 50. Here it comes. Okay, so we're taking off. So, I mean, I hope that everybody who's listening and watching through here, I tried to cover all the directions, but I think that this was a pretty sensible thing for the market to do. I was thinking a little bit more sideways into the close because of the stalemate concept, but okay. But I think that this right here was pretty good. I think this was pretty good. I think this was probably the number one trade right here based on the structure of the market. I think it was, this was high difficulty. Because this took into account the previous day, this structure, daily zero tests, how everything was placed. It's very difficult, very, very difficult, I think, from this structure. But I think that was the best spot to trade. This would probably have been the second spot to trade. Other than that, unless you were willing to pick up an option right here, there really weren't any other opportunities to play this at all, in my opinion. So this is what I'm thinking, and I think you can sit and you can say, okay, well, we know where it's headed, right here. So let me mark that so you can at least get an idea here. We'll say 3202 is going to be easily the spot to get to here. Is that going to happen today? Well, we've got a couple minutes, sure, but that's going to be the first spot to get to because that wraps up the whole flex down. And then maybe we go back and figure out what was going on. So that's where that flex is. That's why I'm picking that. So 3202, we'll say. If you're saying why at 3202, and I'm taking into account the expansion bar, so the little expansion right here, I'm rounding to 0. That's why I pick 3202. I like to generalize and just, so I think a lot of institutional players don't sit and nitpick the numbers. I think they look at it and they say that's what it is and they just go for it. They don't sit and go, this is the tick or that's the tick. This is the exact spot. They generalize a little bit because they got a lot of stuff going on. And if you start nitpicking, you get a little too attached to the market. So just 3202 looks good. That covers the expansion bar. That takes care of that spot there. That's going to be a really strong spot. Say that's where you could easily execute and fill and exit in orders. 3202 is going to be good. If it moves through there, then, I think the market could absolutely consider pushing a new high because I think that would just be detrimental to so many people. But I'm not looking that far into the future. For me, I'm looking at the structure of this whole dip here. This defense, where's it headed first? And this in my head is just clearly like that's the thing it wants to do. We worked out the structure. We found the positions. We see who's going to pay. These guys are going to pay. We know where it's going. We should be all on the same page here about what's happening. Hopefully this has all made a lot of sense. There's not much else to do here. I think you know what's going on. I think you know where it's probably headed. At that point, once the market gets up to that spot, I think the market's going to need to, either it's just going to blast through it or it's going to stop and need to reevaluate. So, Miguel, that's a good question. And I think they do offer some liquidity, but okay, let me just put a little asterisk on there. So my answer is yes, asterisk. I can draw it out. There we go. And that asterisk would read something like it's flexible. And when I say flexible, I mean it's not as strict as the other ones, where the other ones, it's like, oh, okay, well, we have it moving under here, and then we track that right there on it. Like you could see that this moved under, and our flexibility here was a lot. There was a lot of time in it. So you could literally go from here all the way to here and say, somewhere in this section. And so it's something you have to be very flexible about. And I tend to not think, okay, I'm going to buy right here unless there's some precedent for it. Like that's the thing I'm expecting. You had to be very flexible about how you picked up and determined liquidity. So I think yes, but it's not as strict. So you're going to be dealing with a lot of pain if you're not flexible enough about it. I don't really like to try and buy into these things here because of that flexibility, meaning that when you fill an order, maybe if you thought, hey, this is going to pop up, you'd had to sit through a lot of pain and suffering before that things really started to look up for you. And even then, it wasn't like all roses. So yes, but use other tools to get more specific or wait until it's clear to take advantage. So that's why I don't think this was the number one place to get in. A lot of people might say, oh, did you pick the low or something? And I'm sitting here going, well, this was essentially the low of the day because that's when we figured out what was going on. And this was probably the best one because we had somebody to trap out. And now we're able to get our target in place. We know who's going to pay. We know where they're at. I think this was probably the number one spot. But a lot of people are going to say, hey, how did you predict this low? And it's like, well, I knew it was going on, but I don't like to see red numbers. So I waited until I saw it was happening before I acted. Like I like to know what's going on before I get in because I think knowing what's going on, it has a higher success rate than finding an entry that could pay well. Your awesome paying entries will hurt you more often. I like to. I mean, if you track this, you're like, oh, okay, I figured out what's going on before I started going. Here's where I think we're going. Here's what's happening. Here's who's paying. Here's blah 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 blah. I think it pays more consistently and in bigger chunks. They take a little longer. If you've tried to fill an order through this section here, or maybe right through here, it took a little while before it did work out, but the success rate's better. I think for me it is. So yeah, yeah. Hopefully that answers. It's just I don't like to trade those pivots. I like to wait till it's clear, and that tends to not be at the exact high or the exact low. I like my trades. You hop in and they turn green and they work out. That's what I like. I really like that. I like to get exactly what I want and make money while I do it. So there's not much more to do. I mean, we have a couple minutes left in the market. This isn't coming back down. We know that these guys are paying. We watched them even fill, and they were pretty decent size. I mean, you could see they even impacted tension. So these are pretty decent sized positions, and you could see the acceleration there. This is pretty good. So we know that these guys are upside down. A lot of people just liquidated their positions. And this is the spot when I say, okay, this trade is done. But because we got the acceleration right there. And so this is the spot where I'm always like, okay, the trade is over. Structurally, we have a bigger objective here, which I think is getting back up to here. But this is the spot where you can say, if you dump your position right here, you were able to liquidate these guys based on the structure of the market, and this is the whole trade. You can exit here. If you think it's going to go further and you want to see it get all the way up there, you need to buckle up and get ready because you're going to moving from impulse trading. So we just nailed our impulse, which is this. We got our liquidation right there. That was the impulse. This is what I like to trade. It can continue on and hit those targets and continue further and even push new highs. Sure. I want to follow that. I'm going to track the whole story all the way up, the whole narrative, all of it. I'm going to be watching all the samples, the pivots, the turns, the pops. I'm going to be metabolizing them, thinking about what they mean. But in terms of risk, this was the impulse. This was the meat and potatoes of the whole thing. And you can say, I was able to track the narrative. I figured out a good spot to get in. I watched it shove up. I liquidated the counterparty. I got out. You were being backed during this whole impulse. You were being backed by narrative. You were backed by structure. You had liquidity on your side. You took out a counterparty. You had all the things you want That was an excellent move. It worked quickly. It was beautiful. I think there's more in this, but I just want to make it clear. This is the spot where I usually say the trade is done. If you just want to catch impulses, that was your impulse. You can get out here happy unless you're planning on strapping in and holding on overnight and carrying some counter stuff that you may not want to, maybe some more frustrations and stuff. If that's what you're wanting to do, just make sure you make some money. If you caught this move up, great. I'm very happy. Just make sure you take some away, because that was the impulse move that I think is the easiest to catch, the quickest amount of money. It's good, it's sensible, and everything from here is going to be you're going to be depending on this whole structure, this whole story about the structure and the flex and the defense and all these things. You're going to be depending on those to catch a further move up to here, which is okay. I just want you to understand that you're moving from one type, the impulse trade, into the next thing. And this may not be as slick and clean and clear, as easy as the impulse move. I just make that clear. That's the impulse. This is the thing I trade. I look for this. I want that impulse move. And then once things slow down, I see the liquidation. I go, I'm done. I throw my hands in the air, go, I'm done. I'm happy. And then I walk away going, boy, I caught that narrative. I figured out what was happening. I defeated my opponents. I'm good. I think I know where it's heading. And then I can take some pleasure in keeping up with the narrative while having caught the best move in likely most of the rest of how this plays out. And so I just want to make that clear. There it is. There it was. We got our liquidation. Everything slowed down a second. You can exit here and be happy. If you're going to hold, just know what you're in for. Now we're moving from impulse up to into some narrative trading and idea trading and things like that that can be a little rougher. So I just want to make that clear. I got to go take care of a little kid. I'll leave this running for a couple more minutes. If you have questions, I'll be back in a minute to answer those. Just a second. Okay, so the market's closed. I think overnight, if you were able to catch that, great. Tomorrow morning, the thing that we're going to be looking for, the bulls need to see if they can continue to pump tension. We're going to need to trap in some bears, and we're going to need to see those bears get upside down and the bulls come in and pick that up. So it could look something like maybe decay moves up, price moves up a little bit, we get a bearish sample, and then maybe a sample from the bulls. The bulls turn them upside down and push that higher, which would hopefully, if we get a little higher, we could pump tension up. This is the thing right here that the bulls want to see happen. And we want to keep daily tension. You can see daily tension got a little bit further away. We want to see daily tension get a little further. This is what the bulls want structurally. So that's what they're going to be looking for. That's what I'm going to be looking for. If this falls apart, so right off the open, we see the bulls get sampled or something, decay maybe moves down, or we get velocity come down, sample the bulls, and they just, price, we get the sample and they just don't hit. At that moment, we'll be looking at elasticity, which again, 20% is not amazing. Maybe it opens up a little higher. We get like negative 30% or something, which is okay, I guess, better than like they're trying to do earlier. Then we can see that start moving down, and the bears will want to hop into that elasticity and see what they can do on the way down. And the objective, of course, for the bears will be, getting back down here, probably retesting this situation here, the expansion bar. So that would be their objective. See what kind of damage they can do on the way down is what I'll be looking for. So that's where we are. We're bullish. We want to see the bulls come in and continue to pump tension tomorrow. If they can do that, there's a potential we could get this back up to that spot that's important, and even possibly push through some new highs and really just confuse everyone about everything. I think to push some new highs, though, it's going to take more than just generally moving up. I think they're going to have to get some structural things in there to help out to get us up to those areas. Otherwise, I wouldn't expect it to just sort of naturally move up higher than this spot here. Miguel asked, bears have to establish a position before it becomes elastic. Yeah, bears are going to need to get some liquidity. They're going to need to see bulls fail first and then get some liquidity. At this point, bears are just upside down. They're just losers all around. They don't have any positions that are working well for them. And so they would need something. And they would really, I think, need to see the bulls hand it to them. The bulls are going to have to step away, not pick up liquidity. Bears can pick that up and then try and drive some elasticity. But still, this isn't super. I mean, really, if you could look at it this way, you could say, okay, well, the bulls have the potential to move this really high. There's nothing stopping the bulls from just zipping this up and just 100 points higher. There's nothing. There's no reason the bulls couldn't do that. The 20% tension, we could shove this all the way to negative 70% tension. We can get that. And that could be an entire day of just straight up, is what that could look like. So from that perspective, you can say, well, there's no reason for it not to move up or down. There's no like real limitations there in terms of tension. So if the bears are going to get this, they're not going to be running into that natural tension of the market just getting heavy. They're going to need to be handed. They're going to need a position, and it's going to have to be handed to them, or they're not. There's no reason to think that they're going to work. They're going to be able to work that out tomorrow. So I think that the focus tomorrow is the bulls. Can those bulls pump this tension higher all day tomorrow? Can we get this running? Can we trap in some bears? Let's keep this going. Let's just keep it going. That's what I'll be looking for in the morning. I don't think that trying to short this back down is a sensible thing to do yet. If it is going to happen, we're going to need a couple of events before that starts to look more sensible to me. So, yeah, that's where I'm at. If you guys have other questions, I see some posting going on. Hopefully, we see some great opportunities tomorrow show up, and we take advantage of this big emotional roller coaster that's widened out our range and given us some craziness to work with. So that's going to be good. Yeah. All right, guys, I will see you tomorrow. Good luck.